There's a world out there, it's a digital maze where dollars move in mysterious ways. Complex systems, rules, and regulations. The payments professor sparks revelations. No need to fear the Fed now.
Hey everybody, Payments Professor here, and on the Payments Podium today, I am super excited, maybe a little bit more than normal, because I got a couple of guests on that are going to be talking about things from a risk perspective, and you guys know me, I love risk, payments risk. I've told you forever, you want job security, that's the place to go. And I met these people at a conference in California, of all places, and I was blown away with what they're doing, what they're offering, and how they've got just a great pulse of what's going on with the industry. So I'm going to introduce Trevor and Angie, and I'm going to let them explain who they are and what they do real quickly. Let's go ahead and start off with Trevor. Who are you? What do you do?
Great to be here. Thanks, Kevin. Trevor Lain. I'm an attorney for banks. I was a regulatory attorney for many, many years, decades, and have created an automated solution for risk management called LexAlign. We're going to talk today about some of the reasons why we created this solution, and hopefully in a way that's very helpful to your audience today. And with me, I'm very excited to be with Angie Dickinson. Angie?
Angie Dickinson, VP of Sales here with LexAlign. I've been in the financial services world, we'll just say 25 plus years. I've been in...
You started very, very young. That's what it was.
Exactly. I've been in risk and compliance for about the last decade, highly focused in that area. And I think that we have a lot of new regulatory challenges coming our way, and we're excited to, show you how we can help folks operationalize and, understand the 700-page document that, understanding how and what is most relevant to them. So thank you so much for introducing and bringing us in. And we've been at two conferences together now. The first one was WestPay, and then we were at EPCOR.
And I love that you bring that up, because people are always asking, hey, what conference I'm going to be at? Well, whichever conference I'm at, there's a good chance Angie's going to be there too. So you guys really got to come now. But Trevor, my first question is for you, because, part of it is anybody else besides me ever got excited when you said regulatory attorney? But the real question comes down to this. How did you end up in the world of electronic payments? And I mean, really, how did you become a regulatory attorney? Because when it comes to electronic payments, I ask people, how'd you get started in this industry? The answer is typically, I didn't mean to. It was kind of by accident I ended up here. So to become a regulatory attorney and get to where you are now, you got to tell me, how did that happen?
I think it's just, when you're in a town and you go into a business, you end up being in whatever business is the company business, the company town. I was in New York when I started as an attorney, and I just started in financial services and saw a whole range and worked both coasts and in between, and abroad in financial services. And it's really, my career has really tracked where the ongoing or incipient crisis is. What is the big topic of the day? And so we are in payments now, not because I've always been in payments, but because this is what we're dealing with today. And potentially we might get to this dealing with facing the next crisis in banking. So trying to help folks get ahead of it and make sure that financial institutions can survive. So.
Well, I love that. And you mentioned, the next crisis. And I really feel, and I think most people believe, the crisis we have now is fraud and how it's constantly changing. We're seeing a shift actually change from, the old days of debit fraud to this new credit push fraud model, to where we're seeing more business email compromise, more of what people call authorized push payment fraud or authorized push payment scams, things like that. There's the concern with faster payments, with ACH, that all this is happening. So my question to you is how do you see this is changing? How do you see this affecting financial institutions and their business clients when it comes to managing that fraud, the risk that they have in it? What's that look like today?
That is perhaps the most pertinent question. And I would say that we need to consider the operational risk at the periphery. With credit push fraud, customers are now the front line of fraud. To fraudsters, they're the front door of the bank. Bad actors are getting around institutions' on-site fraud detection systems by penetrating and watching the customer, the originator. and then getting them to send or creating authorized credit transfers to fraudulent accounts that match what we as the financial institution, and I say we because that's how I speak as a lawyer, what we are doing, they match what we are expecting to see from the client. And that's how they're kind of getting around our systems. Now, the key point in how we should think about this evolution, as you put it, is that we need to shift our attention to the front line, to helping customers manage the risk of their operations. And that means looking beyond transaction monitoring that we've been doing and doing effectively to customer compliance and security. And why compliance? It's because most of the rules that apply to customers are actually designed to prevent fraud and other losses. To me, this is the inevitable evolution of a migration in banking that started with the technology transformation of banking in the 90s and 2000s that led to the migration of these basic operations out from the bank to the customer site. And I'm sure we'll come back to that.
So basically, if I heard you right, you're saying we need the customers to be able to do more and to actually step up and do more than what we've seen them do historically, because just like the shift is happening, we got to shift who's doing what in this. But you didn't leave out the bank. I got to point that out too. I didn't hear you say the bank won't be involved.
No, absolutely. The responsibility is still on the financial institution. And if we look specifically at the NACHA rules, which do track how the Bank Secrecy Act is implemented and enforced by the prudential regulators, it's that the financial institution has the ultimate responsibility. And that's because the regulators and NACHA don't have direct authority over the customers. They put that authority on the bank. They can only enforce the rules against the bank, so they make the bank responsible, the bank, the financial institution, because also credit unions, responsible for the customer. And so the key to contending with this fraud is to empowering banks to do this at scale. And we're going to use a bunch of adjectives throughout this that I want folks to be mindful of. So if I may, I'm going to go on to a little bit of what the challenge is.
Okay, so but we're all used to the adjectives and the three-letter acronyms. I get that, and if the challenges are keeping up with those three-letter acronyms. And you already said BSA, Bank Secrecy Act, and made everybody shiver a little bit. So help us know, what are the real challenges we have here?
Well, again, and we're going to stick to this theme, the challenge is how to manage the risk of remote dispersed operational settings, so the customer operations. And remember that these were basic operations that used to happen internally in the bank, and that's why the rules that used to apply still apply, even though it's somebody else handling them. And we've talked about the direct authority and how they don't have direct authority. And it's important to know we're dealing with this new rule, the fraud monitoring rule that NACHA has come out with, that pointedly talks about the non-consumer originator and the third-party sender in addition to the ODFI and TPSP. And so we have to think about what is NACHA's thinking about that and the concept of role-based risk management. But it ultimately still comes back to the bank. I would say there's a couple of points about compliance I'd like to make at the outset for folks to understand. First is that
when you're making these, can I just be clear, because you mentioned that fraud monitoring rule, and that new fraud monitoring rule that's putting all that responsibility on ODFIs, originators, even you've mentioned third-party service providers that are out there, third-party senders. That is a big concern in the industry right now. So I'm sure, as I point this out, people are perking up and going, let him talk, because we want to hear, how do we solve for that? It is a big, huge issue, operational compliance ways. So what is the solution?
Okay, well, let's start with the basics.
Okay.
First, when we talk about compliance, what do we mean? We're talking about records. Compliance is records that show that something that was required to happen did happen, or that something that was prohibited did not happen. And for information to meet this standard, it must stand up to an audit, exam, or legal actions. That means it must meet the rules of evidence. Okay, so that's the first thing. We're talking about records.
Okay.
Second, and this is also really important, compliance is not all or nothing. It's not 1 or 0. And just like we say perfection is the enemy of good, it's not okay to say, since we can't do this perfectly, we're going to throw up our hands and give up. We have to try. We have to do something. We have to be able to show that we're making a good faith, serious effort to do that. And so how do we do that? and I'm hoping this is useful for the audience. The standard that we can use is what's reasonable under the circumstances, which means in light of the risk and what's available to us. Now, the risk is obviously huge. We've already gotten into that. The rate of growth in fraud and fraud techniques is well beyond what we can tolerate as the risk of doing business any longer. But second, and positively, the resources at our disposal are constantly evolving as well. And so doing what's reasonable under the circumstances not just means what's the risk, but also what are the tools that are available to us, and leveraging those resources that enable us to do more in order to create the records that demonstrate that we're making a good faith, serious effort to do so. So if technology emerges to enable us to achieve a material higher level of compliance and we don't make use of it, then we better have a really good excuse as to why we're not doing that.
Okay, I got to ask something because, I love this. You made it real simple for me. I can get this. It's records and it's not all or nothing, but do what you can. And you said reasonable and good faith, things a lawyer's going to say. Just got to point that out, Trevor. I mean, just got to go there. All right. Reasonable, good faith, but reasonable under circumstances, knowing the risk. Is it the same for everybody? So if I've got, say, a small credit union that's just here in my town versus a large regional bank, would it be the same for them, or is the circumstances different for them?
There are multiple factors you should take into account when in understanding what's reasonable. You've pointed to one, which is what's doable. I mean, where do you have the resources and all the rest? But you also have to look again at the risk. If you're a small financial institution, but you have a large exposure to ACH and ACH customers, then you should be doing more than a comparably sized institution that has a relatively few. So you have to align your resources and your attention, these are precious commodities, to where the risk is and have a reasonable basis for how you are allocating your resources accordingly. But the positive thing about the new technologies is they allow us to do more with less. And that's why we should take advantage of them.
So technology is evolving, and I love how technology is evolving. I almost, I got so many other questions I want to ask, but I almost want to just jump ahead and go, okay, how can the technology help with this? I mean, what is out there? I know you guys have come up with a solution, and that's what I'm really dying to hear and share a little bit is what technology really solves for this? How's it going to solve for this? How's it get past these obstacles that are in the way? What do financial institutions need to do to be able to monitor? And it's really about everything that's going through their hands.
Right. So there's a concept here of how do we manage these remote operations at scale? And let me put that in a little bit more useful terms. There is a practical obstacle. And that is, it really comes down to data, but how do we collect that data? And the practical obstacle is that manual efforts just can't do this at scale at any reasonable cost. So risk management we need to be proactive and effective, but also efficient. And again, I'm going to use adjectives that are measurable. So proactive, effective, but also efficient. Now, risk management of remote operations doesn't mean that we need to spend the same amount of time on everyone. That's good news. A common theme in regulatory guidance is that we should do risk-based risk management. And that means it's okay to prioritize our efforts on the actors or operations that present the outside risk. So we're going to add targeted to that list of adjectives. But how do you do targeted risk management without data? So we need data to determine which customer operational setting presents the most risk. The problem is that to date, we've relied on indirect data to determine that. So we've relied on transaction monitoring and return rates for ACH. Now, transaction monitoring is useful to detect some kinds of fraud, but it's not a great tool for remote compliance management. And as we discussed, bad actors are using sophisticated techniques to mask their fraud as legitimate and expected customer transactions. Monitoring return rates, on the other hand, is an indirect measure of certain compliance risks like authorization gaps. And so it was very useful when debit fraud was, presented the highest risk to ACH and account holders. But in the era of credit push fraud, it's not a direct measure of the operational compliance or risk generally, and it's not a great way.
Trevor, I got to tell you something. As somebody who's been working in this industry for, we're not going to say as longer than Angie, 3 decades. You just said things that I know. This is what I know. All right. I know transaction monitoring. I know return rates. I understand the authorization gaps and improving all these authorizations. And it sounds like you're about to tell me, forget all that. I got something better and that I should change my whole point of view. Am I right? Because I got to take some notes if that's the way it's going to be.
I'm certainly not saying that. I'm certainly not saying it. We need to do transaction monitoring, and we need to monitor return rates because those kinds of frauds have not gone away.
Okay.
And certainly Notch's rules, which read sort of like an archaeology of fraud, do still apply. And so that compliance is still required in those cases. And there are great solutions out there for that. And there's a good aspects to that. But it's important to know that when it comes to this new kind of fraud, the customers that present the most risk to us might not be the ones that are most active in terms of volume or velocity, or the ones that have the highest return rates in terms of which ones could present the most risk to the institution. So we need specific data on customer compliance and risk management in order to develop the kinds of proactive, targeted, efficient, and effective risk management I've been talking about. Risk management at scale depends on setting up routines, but in order to trigger a routine, you need to have a data point. And that means we need to be able to collect data that is different from what those other tools enable us to do. And that's the challenge. But fortunately, as I said, there are new technologies emerging. We like to think that ours, LexAlign, is one that does enable us to do that. But let's keep it on the basic points here so we can help folks think through these
What
issues.
data? That's what I got to know. What data you got? You left the best cliffhanger right there. That was amazing. And I cannot let you pass up archaeology of fraud. I mean, that was the statement of the day. But it's you're right. It just shifted. It's changed. It's different. What do we look at now? What are you doing? What is LexAlign doing?
Well, what we're doing is we're solving the deficiencies of how people were collecting that information in the past. And a lot of it relied on the one hand, providing educational content to customers and then presenting them with a questionnaire. Typically, we're talking about how a customer is managing their compliance and their risk and determining if they are being responsible enough or need help in order to determine which customers we need to focus on, reach out to, and help. Typically, questionnaires ask if a safeguard has been implemented. I'm going to take you through the basic steps here.
Okay.
Or whether a customer is compliant with their agreement. Those questions don't provide adequate evidence, again, that word, that a required or reasonably expected safeguard is effectively in place, right? So, for example, take dual control, which includes dual authorization but goes beyond that. So it's a safeguard that regulators mention again and again as it's one of the most powerful in deterring fraud. Now, a questionnaire might ask, have you implemented dual authorization for ACH or wires? With those kinds of questions, it's easy for the customer to know what's expected, and it uses words whose meaning in practical terms might not exactly be clear to the average person. As a lawyer, I also have a particular problem with this. So if you indulge me, under our laws, in a communication between a customer and a bank, the legal duty is on the customer to be candid. It's not on the bank to verify. And dishonesty in the context of obtaining credit from a bank, so which includes ACH wires or RVC for that matter, if a customer is dishonest in order to obtain those products, it's a criminal action under the law. So I'll let you guys connect the dots, but using a data gathering approach that we reasonably know will induce the customer to be inaccurate is, to understate it, problematic. So how do we do better? To enhance the chances we'll get a more accurate answer, we could ask the question in a way where yes means no, and in a way that's much clearer that we're asking someone to tell us about their operations, even if they don't have a relevant knowledge in what we call the 3 R's: rules, risks, and responsibilities that apply to them. So, for example, a question like, is there anyone on staff who is both permitted and can originate a wire without input from any other person? This is a clear question your customer should be able to answer, Also here, yes means they don't have dual control. So we're
Oh,
not
that's a
leaving
bad
them
yes. I was
in.
about to say, wait. If I ask somebody that and they say yes, I'm going to have a little minor heart attack because it goes against all your three R's you just mentioned. Okay, I mean, I got to tell you too, I'm getting a little excited. This is fun. This is why when I was in California, I'm like, I got to have Trevor on here. Tell me more, please.
Yeah. So the idea is to get an accurate answer from them so we can actually help them. And we can help them both in an automated way and in live manual ways. So one of the ways we can help them is by giving them an audit report that says, these are the rules that apply to you, and here's where you have gaps, and here's an action plan. Here's something that you can do about it. This can all be automated, as we've demonstrated. And then a remediation checklist so that you're empowering them with pertinent knowledge. In other words, we're making information on the rules, risks, and responsibility accessible, pertinent, and actionable to the customers. Again, three more adjectives. Instead of giving them, as Angie said before, a 700-page book and saying good luck, or giving them access to an FAQ page or something like that, we're actually taking them through the fundamental steps of a risk management program, which is enabling them to do a self-assessment against that framework, rules, risks, and responsibilities, and then giving them the crucial information they need, where they have gaps, what to do about it, action plan, remediation checklist. We can also give them policies and procedures, and then we can score them and bring it back to the bank. This is, as I said before, it's all about data, and it's about also creating a flow of data so that data goes out to the customer in a way that's accessible, pertinent, and actionable to them, even if they have no background. That's in the three R's. But then data about the customer comes back to the bank to enable what we described as proactive, targeted, effective, and efficient risk management at scale. You'll know which customers to spend time on. So that was the data, the loop that was missing that we saw.
The approach that we've done, which works for debits, and I still think it will and always will work for debits, to change it for credits and some for debits too, you found a better, newer ways to be able to work with, quiz and talk to and get information from the clients to know that what they're doing is wrong or right. You then provide a report back to them. You show them that they've actually conducted a self-assessment. It's like you're helping them in their own compliance as well as the financial institution. And then it also sounds to me like then you also have this opportunity for not only documenting everything and having this audit report, but education that can take place too.
Everything is done in a way that creates records of risk management, tells a story of risk management. But the fundamental point is we've given them the opportunity to handle these operations. We need to also empower them to do that in a way that is compliant and safe and manages the risk of their behavior without just saying, good luck, go find the rules. The rules in our system come at you from so many places. It can be a statute, it can be a reg, it can be guidance, it can be a bulletin, it can be an exam manual, it can be the preamble to the change in a new rule. That's where regulators communicate what they expect, what they mean. It's too much to expect most of our clients to find that for themselves or to even
Preacher,
know.
brother, I'm with you on this one so much. Go ahead, keep going.
So the concept is to bring that to concentrate that in a way in a very accessible tool that's very light touch to the customer, doesn't take them much time, where they actually get something from it, and engage them. And we find that institutions that use this approach get a lot better engagement with their customer, which solves another problem, incidentally, that arose with this technology transformation of banking and this migration, which is not only did we lose visibility on these operations as they moved out to the customer, but we also lost a level of engagement, of communication with our customers. Our customers are no longer bringing checks by the bank on a constant basis, no longer calling their banker for help. And the net effect is, and we're a couple of generations beyond that now, to the customer, the bank, unfortunately, is no longer considered like a trusted business partner. It's now a utility. And so we're facing higher levels of attrition and other risks because it's easy for customers to say, yeah, I'm just kind of not happy with this level of engagement. I'm just going to switch to another bank as if it's another cell phone provider. And so We want to provide this information and this empowerment of the customer in a way that also enables them to engage with the bank. And indeed, empirically, we see the customers engaging. We see, 80% or more customers doing their self-assessment. We also see them taking advantage of opportunities to communicate concerns to the bank. So we're detecting a pent-up demand from customers to actually engage with their banker. And then on the bank side, responding to that leads to higher engagement, higher retention, and also more sales because you see what the customer needs.
All right, this is the face of shock and awe. I'm loving every bit of this. But I got to tell you, I got to ask another question or I'm not going to sleep tonight. Because this has been a lot of ACH focused, and we're seeing instant payments grow. We're seeing FedNow, we're seeing RTP grow tremendously. Are you able to keep up with that too? Does any of the risk change with that? Is what the industry is doing going to be enough? And are you helping to solve for that? What's it look like when we go in the realm of instant payments today?
Obviously, instant payments put us in a bind because we don't have a choice but to provide it or our customers are going to leave. At the same time, we all know that it's going to accelerate fraud, and the fraudsters are preparing for it. They're already using instant payment and conversion to crypto and all the rest to make ill-gotten gains irretrievable. And this is just going to get a lot worse. Now, obviously, banks at their institutions at their own side can monitor which customers they want to provide that to and where they might want to put in delays and all the rest. AI will also accelerate this problem. We are at base a compliance tool. We're trying to help with compliance. And so we put the onus, and forgive me to all the regulators out there, but we put the onus on the regulators to tell us what they expect. We don't want institutions held to any higher level of compliance than what is actually out there. So we track against what the regulators say they expect. But the regulatory response to the fraud is also happening. And so we see new rules and we see new guidance. And so it's important for us on our side to update our solutions to match, to track what the regulators are saying they expect so that banks can then demonstrate. I think there's a fundamental point here, which is that the risk is not just the loss in fraud due to the fraud. There is a lot more to that. And we can talk about risk as sort of, disruption in normal business operations. There's a risk of non-compliance, which is different. And non-compliance doesn't track as a risk. It tracks as an accelerator. So that when there's been something bad, that's when you need to worry about non-compliance, because that's when things can get much, much worse. I don't want to keep going without offering you the opportunity to ask a question.
Trevor, I got to tell you, you speak my love language, and it is risk and payments, and this has just been amazing, but we're running out of time. And I know I got a lot more questions, and I guess the last question I got to ask you, because I'm sure people watching this are going, where do I learn more? How do I find out more about this? How can somebody, one of my followers, get a hold of you, maybe get a hold of Angie, find out more information on how you've got more than a basic tool. This is some awesome stuff going on right here. Where do they go? How do they get a hold of you?
Well, they can always visit our website, which is LexAlign.com. It's LEX, which is Latin for law, align, ALIGN, alignment.com, or contact Angie. Angie, do you want to give your email address?
It's Angie.Dickinson, DICKINSON, just like the actors from the 70s, at LexAlign.com.
All right. Well, thank you both for being on today. This has been great. People who know me are like, oh, wow, he's super excited. I need to learn more about this. And I think all of you that are watching right now, listening, you probably see why as soon as I met these guys, I'm like, you got to be on. You got to come share this because I love that they're taking a new, innovative way of looking at things. And for those of you out there, if maybe there's another topic or maybe there's a speaker you think needs to be on the payments podium, all you got to do is email me, message me, send me something, say, hey, professor, get so-and-so or get this topic on here, and I'll do all I can to get them on here. But this is the part where I get to say, class dismissed.
There's a world out there, it's a digital maze where dollars move in mysterious ways. Complex systems, rules, and regulations. The payments professor sparks revelations.